The following is a special message, recorded outside the usual weekly updates, with insights that couldn't be shared until now. Here's Steve Reinharz.
Hello, everybody. I'm Steve Reinharz, CEO, CTO, and founder of Artificial Intelligence Technology Solutions. Recently, on one of the weekly videos, I was talking about the relationship between share price and market cap. And a lot of what I said was struck by our legal review before we were able to publish it. And there were a few reasons for it. This time, the information that I'm about to share has been written in a script and shared with legal for approval and adjustment prior to me sharing the information with you. Usually, my process is I have a few bullet points for the weekly video primarily, and I get up there and I share, and after that, it goes to legal, and they might strike out a few things, but usually it's 99% on target and there's no problems. But in this particular case, since we're talking about shares and companies at large, and we're not specifically discussing AITX, I still went to the extra effort to make sure that this script was modified and approved by legal before launching into it. So let's give it a go. You'll see me reading, by the way, folks, and it's not my style, but that's the situation that we have here. I want to take a few minutes to talk about something that comes up a lot when people are doing due diligence on public companies, especially smaller and emerging companies. It's the relationship and obsession with share price, outstanding shares, and market cap. And most importantly, how you can be thinking about these elements as just one method by which to judge a company's value. Here's the thing. People get fixated on a company's price per share. You'll hear things like, oh, it's under a penny, or oh, that stock is only 10 cents, or oh, that stock is $2, whatever the number is. Imagine if it went to $1 or $3 or $10. But share price alone tells you nothing about the metrics in judging true value. Growth prospects, assets, revenues, future cash flows, market conditions, product, competitive landscape, uniqueness, and so forth. It's like judging a pizza by the size of a single topping without knowing how many slices there are, i.e., the ongoing fundamentals. The real number that matters, along with further analysis via a company's fundamentals as shown in filings, is market capitalization, or market cap. That's the total value of all outstanding shares, i.e., the entire equity of the company. And it's simply calculated. It's the share price times the outstanding shares equals the market cap. Now, whether a company has 1 billion shares at 1 penny or 100 million shares at 10 cents, both companies have a $10 million market cap. So the question is not, that share price is really low. The question is, does this company's market cap reflect what it's worth today and tomorrow? And from there, particularly with small and micro-cap companies and even many, many mid-sized companies, the question is if the outstanding increases, can the company growth in value outpace whatever dilution that increase might bring? And this is where you start digging into the fundamentals. Are revenues growing? Is the value proposition getting stronger? Are there more customers using the product? Is the customer base increasing? Is the product set increasing and improving? Are they building something scalable, defensible, and unique? Are they managing expenses and debt responsibly? If those fundamentals are improving, but the market cap isn't growing at the same pace, that might be an undervalued opportunity. Think about companies like Tesla. For example, in the early 2010s, the share price was bouncing all over the place. But if you looked at the market cap alongside the technology, the manufacturing expansion, and the revenue trajectory, you could see where it might go. That's the kind of thinking that long-term investors benefit from. Not what's the price per share today, but what's the business worth and what is the market cap and is it aligned with where I think it'll be in the future? Now, let's talk about share count. Let's talk about outstanding and authorized share count, because yes, sometimes, even often, companies increase their outstanding and authorized shares. If there's nothing else happening in the company, such as increasing revenues or investment in technology, that could be a red flag. But if the company is improving faster than the share count is growing, meaning the revenue, contracts, intellectual property, and strategic value are all rising, then the value per share can actually go up even if the share count goes up as well. A strong example to reference here are biotech companies that raise capital to fund R&D. The question isn't as much, did they add shares? It's, did they create more shareholder value than they diluted? It's not about perfection, it's about trajectory. So the next time you're researching a public company, especially a high growth or early stage or both type company, start with the market cap, not just the share price. Then look at the fundamentals and ask yourself, is the company getting stronger? Is it solving real problems? Is it doing so faster than it's diluting? If yes, then regardless of the share price, you might be looking at a good long-term opportunity. I hope this provides some color to how you evaluate your investments. Thanks for watching. Have a great day. Leave some comments, like, share, and subscribe. See you around.